Hello, everybody. Just getting started. I don't have any guests today, but I'm waiting for people to hop on. I just started, so I'm just going to wait a few minutes. And in the meantime, I'm working. Just doing a little bit of paperwork. So I hope you are all doing quite well today on this beautiful Thursday. And when you hop in, please say hi. So that way I know you're there, because I can't see who's viewing unless you introduce yourself. Okay. All right, I've got 2 people on so far. Hello. Please say hello. Introduce yourself so that way I know who's here. I know I have a few people who said they would be here, so I'd like to wait for them, and then who said they would be here at the beginning. So, hi, Sarah. See you. Sarah, I'm just waiting for a few more to hop on, and then we'll get started into the conversation. I'll introduce the topic. Welcome, everyone, to my home office. I think while I'm waiting here for some people to hop on, I'm going to turn my computer, my email on Do Not Disturb, just so I'm not constantly interrupted. Okay, it's 12:02. I'll wait just a couple more minutes. If you're on and you just joined, please say hi so I know you're here. Otherwise, I don't know who's joining me. Got another guy joining. Thank you. Welcome. Welcome, everybody. Make sure to say hi so that I know who's here. Okay, I've got 4 folks so far. I think I'll get started. We're about 3 minutes in, and I'd like to end by 12:45 or maybe at the earliest, and I could go longer depending upon the questions, but I just want to get started. So it's Whitney Emanuel with Strategic Visionaries. Thank you for joining me. We're talking about the building blocks of financial planning today. Hello, Pam. So glad you could join. I hope your closing went well. So we will be discussing the building blocks of financial planning. Anytime you hop on, please say hi so I know you're here. And that way I know who I'm talking to. Hey, Jenna. Thank you for coming. Know that if you comment on the video, then I'm going to find you on Facebook and friend you on my personal page. So that's what you get as a result of this video, in addition to the education. So welcome, everyone. So I'll get started. Please, as you hop on, just say hi. In fact, I think I might make a comment. As you hop on today, please introduce yourself. Okay. So I do this once a month where I do a live broadcast. Usually I do it with this special guest, but today just me, because I wanted to really just dig into the basics of financial planning and what that means for people. So I thought it would be a good one to do, and that's why I asked some of my clients to hop on so they can share their best practices and experience of building their financial foundation. So with that said, and without further ado, we'll hop in. So when we're talking about financial planning, oh, one other thing. I do have Zuri, my daughter, is not here today, but for those of you that received my newsletter know that I have a friend and her 3-year-old staying with me, and the 3-year-old does not quite know how to not interrupt. So she might be a little loud, just so you know, but it shouldn't be too much of a disruption. And it's very fun having a 3-year-old. It makes me remember. So with that said, we're going to talk about financial planning foundations. So let's first talk about budgeting. And I'll kind of give you an outline before we hop in. So first, we're going to talk about budgeting for today, and then budgeting for the future. What does that mean? How does that look? How do you get started? This is a big roadblock for a lot of people, even people who have a lot of income or a lot of wealth. Trying to figure out your budget can be, a pretty big determining factor in your plan. So I want to talk to you about that. I want to talk to you about automating your financial habits. So how can you make things automatic? If it's automated, it's more likely to happen because it's out of sight, out of mind. And then lastly, I want to talk about just ensuring your financial plan, because if you aren't protecting your goals, then how can we expect to achieve them? So those are the 3 points that I will be covering today. I welcome any questions, pop them in the chat, and then we will go from there. So let's start with budgeting. And so when we talk about budgeting, really when we break it down, we want to talk about what's going in and then what's going out. And so we look at your income, whether that's your actual active income from your work, or it could be your income when you're retired, which would be your Social Security and your pension. So you total up all your income. And when we talk about your budget, we're not talking about your gross income. We're talking about your after-tax take-home pay. And when you're self-employed, that's a little unique because you have to pay the self-employment tax and maybe sometimes estimated taxes before you can really determine what you're taking home. That's also important when you're looking forward into retirement. What is your take-home pay going to be in retirement? For example, I have clients that are withdrawing from their IRAs right now, and that's 100% income taxable. So that's going to be a reduction in income. If you just look at the withdrawals, you also have to consider the taxes. So that's very important. I see Sarah here. She's on YouTube. She says, that's my big question. Where do I start or how do I start? I'm so glad to be here. I'm glad you're here too, Sarah. So when we're talking about getting started, it's the budget. The budget is the foundation to every financial plan. And I always tell people that you have to track what you're spending in order to know how much money you have left over to save, because your budget determines your savings rate, right? And so that is if you're pre-retirement and you're saving for your children's college, or you're saving for retirement, whatever, or maybe a house, you have to know how much money do you have left over to allocate to those goals. That's the big question. How do you get started? However, if we want to even go bigger picture, you really have to determine what your values are. And I go through a values exercise with my clients in order to determine what's really important to them and what do they value, and making sure that their financial actions are in alignment with their goals, right? So if security is important to somebody, but they don't have control over their budget, and let's say they are underinsured when it comes to disability insurance, if they become sick or hurt, they won't be able to create income, right? Well then, and if they don't have that protected, they're not operating in alignment with their values. They're willing to take on more risk than they say they're willing to take on. So really reconciling the goals versus actions is really the best place to start before you can even dive into the budget. But then once we're getting into those details, that's when we talk about the budget. I actually do have a budget tool that I use, that my clients use to get started on step 1 of the financial plan. It's a budgeting spreadsheet, and I am happy to share that. I'm going to defer to Sarah. She's on, and she's my marketing consultant. And Sarah, is that on my website under resources? I can't remember if we put it on there, because if it is, then I could just put that in the URL, or if you could, about where my budget is. Because then people can just literally download the budget that I use with my clients, and it's an Excel spreadsheet. It calculates, you put in your after-tax, your take-home income. Again, you have to look at your take-home. It does not matter what you get before taxes, it matters what you get after taxes, because that's what you're actually able to spend. So look at your take-home income, and then you total up what all your expenses are, and then that determines if you're overspending, like if you're in the hole, or if you have a lot of money left over, you probably, and you don't think that you do, you might have some untracked expenses. So what I personally do for budgeting is I have, so once I start with the budgeting spreadsheet. I practice my own advice. I put all my expenses into that spreadsheet. Then from there, I could determine what the spending category should be for, or what the spending limit should be for each category. So my dining out limit is $150 a month. It's been a lot less since the shutdown, but yeah, that's what I would say is creating a limit for each of your budget categories. It really helps you control your spending. Depending upon the software that you use, it'll alert you if you go over budget. So Sarah says that is the process should be available by tomorrow. So my budget is not yet on the website, but I am happy if you do want it. If you want that budgeting spreadsheet that I use with my clients, then please just shoot me an email or just go ahead and post a comment here and I'll make sure to get it to you. It's really helpful. It's automated. You don't have to do math, which I like. The only math that you have to do is adding up your expenses and then putting them into the spreadsheet. So I really like it. It's valuable. It's just like dieting, right? So how do you control your eating habits if you're not tracking what you eat? Same thing goes with your spending. If you feel like you're spending too much, overspending, not sure where your money's going, you have to track where it is. And that's very important. Same exact concept when it comes to your budget. So again, talking about your budget today, right? But now, I mentioned this before, but we also have to consider your budget for the future, okay? So that's where, when I'm thinking about retirement, your retirement budget. And really, that depends on how far into the future that is. And everyone eventually is going to retire, whether it's by your choice or not. You're not going to be able physically to work until the day that you die if you live a long life. And so you have to plan for that. And things to consider with your budget. Let's say you've totaled up all your expenses and you determine that you're spending about $100,000 a year, just to keep it simple. But you also have to consider medical expenses. That is an additional expense. It's completely different inflation rate than your normal expenses. The cost of healthcare increases significantly more, twice as much as regular expenses do every year. So 1, healthcare, 2, inflation. The inflation rate is at about 2% now per year. So think about it, 100,000 right now. I'll just do the math. 100,000 right now. However, that's the present value. I'm using my fancy calculator. So present value, $100,000. But let's say my inflation rate is 2% a year. And then let's say I'm retiring in 15 years. So 15, future value. 100,000 today with a 2% inflation rate is $134,586.83. So that's the type of impact that inflation has on your portfolio. You've increased your expenses by 30% in 15 years, okay? So that's why it is so important to take into account inflation. It is the biggest drawdown on your portfolio. That's number 1. Number 2, taxes. We have no idea what taxes will be in the future. We do know what they are today. So that's why as a self-employed person, you want to make sure that you're tracking what your taxes are. And I recommend having a bank account, specifically money set aside for your quarterly estimated taxes if you're self-employed and you are just a sole proprietor. However, if you're an employee, you don't need to worry about that as much. And then another thing is the taxes in the future. What are the taxes going to be on my portfolio withdrawals in the future? And this is why it is so important that not all of your money is in your pension or just your 401k, because it's not as tax advantageous, okay? So what do I mean by that? You put your money into your 401k today, you're getting a deduction, okay? I work with a lot of my clients on this. So I make $100,000, but I put in 15% into my 401k. Now I made $85,000. So great, I get a tax cut today, right? Now that grows into my 401k and it grows every year and it grows consistently in whatever the portfolio is returning. Now let's say in retirement, my portfolio is worth $1 million, okay? But let's say I am taking withdrawals from that every year. And let's say I'm taking out $50,000 a year from my 401k. I'm not even taking into account Social Security or any other type of income, just 401k. If I'm taking out $100,000 a year, I'll tell you on a federal level from my tax table that I have here, if I'm making $100,000, I am in the 24% tax bracket. So what does that mean? That means I'm paying up to 24% of taxes on that $100,000 or $50,000 withdrawal. So that would be about $12,000 a year in federal income taxes alone that I have to pay as a result from withdrawing from my 401k or traditional IRA. that is a significant impact on your portfolio, and you have to consider that with your budget. Let's say you require $50,000 a year of income, but you're going to need to withdraw. Let's say your total taxes are 35%. Let's say that's federal, state, local taxes. So let's say I need 50,000, but I need to take out 35% of taxes. So I'm dividing 50,000 by 0.65% because that the remainder is 35. It's math. That's my job. You don't need to worry about that part. So if I want a net $50,000 withdrawal from my retirement account, I need to withdraw $76,923. See what significant impact that taxes have on your portfolio and your retirement budget. It makes such a big difference. So that taxes and inflation are two big considerations for your future budget. But also, you just have to consider, what am I going to be spending? How much will I be traveling? People think that their spending goes down a lot in retirement, but it really doesn't, because you're going to be traveling. Your traveling expenses tend to go up. Your leisurely expenses go up. If you're not working, then what are you doing? Dining out, enjoying hobbies. Like I said, travel's on the lockdown now, but that's short term, right? We're going to be back to travel soon, and you're probably going to want to do more of that when you're not working. So that is going to be an increase of some expenses, but a reduction in some others. Like, you're not going to be paying payroll taxes anymore. You're not going to be commuting as much for work. So there are some things that you'll cut down on, but there are others that will go up. So I generally tell people, don't count on a reduction of expenses in retirement, except maybe your mortgage and debts. The debts are going to go away, but everything else will stay. Again, anyone, if you hop on, just say hi if you haven't already. I know Pam, Jenna, Sarah are on. And another thing is, if you have questions as I'm going through, please just ping me, put it in the comments, and then I'll make sure to, I'll be sure to respond to your question. There's a little bit of delay in the video, just so you know. So I may move on to my next point, but I won't miss your question. So, water break. Okay, so I talked about inflation, I talked about taxes, I talked about actually calculating your budget for the future. So those are some of the big ones that I would consider. Another thing is volatility in your portfolio, making sure that you have some more secure, safe investments in your retirement portfolio as you approach retirement. And again, that has to do with your budget. The amount of your withdrawals don't change even if the market's down. So making sure that you have a really well-diversified portfolio is important. So that covers the budgeting side of things. Healthcare, I mentioned, is another additional expense that's pretty significant in retirement. Do I have any questions from any of you on budgeting so far? Excuse me. And if not, I'm going to move on to automating your financial habits. So why don't I transition a little bit? So automating your financial habits, what do I mean by that? This is one of the most important concepts that I talk to my clients about. If it's not automatically happening, it will not happen. Okay, so this is even with budgeting. So let's talk about automating your budget. A lot of my clients use tools where they can sync their bank accounts to their budget. And an example of a software that is like that is Mint. Your bank account just streams into this website, and then you see those expenses going through, and you can categorize them, and you can create a budget. It's automated because your bank account is just automatically linked to the software. And I know a lot of people that like that. It creates less work for them. I personally like to manually input my expenses, but it's a habit that I've created. So I just save all my receipts because I'm kind of old school. So there's automating your budget. Daily Budget is an app that a couple of my clients use, and they really like that. So that's another one. And then You Need a Budget, YNAB. That is another one that people really like. In fact, I'll just put those in the comments. So that way, if you're interested, Daily Budget and Mint. I also use Microsoft Money. That's my personal one that I use. So budgeting tools plus my spreadsheet. More to come. All right, I just input the the budgeting tools that I use. So with all that said, we've got automating. Now we talk about savings. So savings, and how do you automate that? So that's why the budget is so important, right? Because if you don't know what your spending and your income are, then you don't know how much you can save. So that's a really good one to consider, is how do you determine how much to save? And then once you know how much to save, then you automate it. It automatically happens. I have a question from Sarah. She says, how do I automate when month to month my income changes? That's a really good question. So let's say you're self-employed, right? And you've got a gig one month, or you've got a deal and you close it, you have a huge month, and then the next month is really dry. That's why savings is so important, because if your income is fluctuating a lot, then you need to make sure that the good months you're saving more, and then in the dry months, the savings that you've already set up is funding your expenses in the future months. So with all that said, let's say, I'll give you an example. Let's say I'm a realtor. I have some clients who are realtors. Pam, for example, is on right now, I believe. So let's say you have a big month of closings. You've got a couple closings and you made $30,000 that month, right? But let's say your expenses are only $8,000. So of course, you're going to pay for your expenses in that month. What I generally recommend is you could pay your expenses in advance. I do that because my budget is generally consistent with my wealth management, but I get new financial planning clients. I have new insurance contracts that I write. So that's where my variable income comes into place, and that's where I get some bumps. So for me, all my bills are being paid from my consistent income. Then I have the variable income. So what I do is that I always save, especially if you're self-employed, you get variable income. So I save about 25 to 35% of that extra income towards taxes. So I off the top taxes. I do it. It can't be automated per se. It can't happen without me doing something, since that income changes. But I just have an account and I just put it aside because I'm going to owe taxes. I know it. And I'd rather pay a little bit more than have to owe. So that's one thing that I do. I also have a retirement account that I set up for myself. And so anytime I get extra income in a month, I just do 15% at least into my SEP IRA, which is my self-employment IRA. So just the moment you get paid and it's a really good month, you take money off the top, then the rest you can pay for your bills in advance, and then just have some extra money. And if you still have extra money after you've put all your money in savings, then you have some extra money to go enjoy. But I know some clients that will pay maybe 5 to 6 to not 5 to 6, about maybe 2 to 3 months of it in advance of their bills, and it saves them a lot. It saves them a lot of stress. It saves them a lot of time, because then they don't need to worry about the bills for the next few months. And I really like that strategy, and I do that. I pay at least a month in advance, sometimes 2 months in advance for my mortgage, my utilities. It just is such a game changer. Insurance. Did that answer your question, Sarah, about automating when your income changes month to month? Any other questions about automating those immediate expenses or those immediate savings goals and expenses? When it comes to long term, it's a little bit different. The general rule of thumb is that you want to save at least 15% of your income towards retirement. That's minimum, because let's say you make $100,000 and you are participating in your company's 401k, or if you have a 401k for your own business, then the maximum amount that you can put into that for 2020 is $19,750. So why not max it out? So that's what I generally say, is max out your 401k. And that would then, in and of itself, if you're making a decent income, is almost 20%, 19 to 20% of your income, depending upon how much you make. If you're making more than that, it's only 10% of your income, whatever that may be. You know the numbers for yourself. But maxing out the 401k is a very, very, very easy way to automate your savings. If you're self-employed, it's a little bit more complicated, but again, paying off the top. Yes, Sarah says, yes, so great, I like paying ahead. It's a great yes, isn't it? It makes such a difference as far as peace of mind, I think, because money can be such a stressor. And so if you can pay in advance, then you're going to have much more peace of mind, and you're not going to be stressing about the next couple months' bills, especially because we all know with coronavirus and the COVID shutdown and everything and people out of work, how important it is to pay ahead when you have good months, right? So automating as well. So I mentioned savings. Another side of savings would be IRAs. You got your 401k through your work, but then you have your IRA that you have on your own. And what I have my clients do is set up an IRA or Roth IRA that they do on their own. And let's say they get paid bi-weekly. You can just automatically set aside the most that you can save into an IRA every year if you're under the age of 50 is $6,000. So $500 a month just comes right out of the bank account, goes into the IRA. It just happens. They don't have to do it themselves. They don't have to manually, because when we get in our heads about how much money we're saving, then we don't do it, even though we probably have the capability to do that. So that's why I really like automating savings, especially for retirement. 401k, IRA are just two of the basics. Same with insurance. Just automatically pay in monthly. It just keep it easy for yourself. So those are some examples of automating your habits. Let's say you're saving for a house or a more short-term goal and you want to set aside money in savings. Every time you get paid, you just transfer money from your checking account to your savings account, and it just automatically take it from yourself. Do not let yourself spend it. Don't even see it. Just have it automatically done. If you're with an employer that provides direct deposit, you can direct deposit money directly into savings, even at another financial institution. So it's completely out of sight, out of mind. But my clients are amazed at how much money they save just by not even having to do anything. I just make them automate it. I mean, I get their permission and then we automate it. But I prompt them, I coach them to automate. And then when that happens, they're so surprised what they have after just a year or two that they wouldn't have had if they hadn't have automated. So I really like that strategy. Okay, so any questions on automating? If you just hopped on, please introduce yourself. Otherwise, I'm going to talk about insurance and how that's really important to your financial plan. Again, these are just the basics. So I'm not getting into like how to allocate your portfolio. I'm not going to talk to you about every single type of insurance that you need or all the various accounts that you should save into, because that's when you should meet with me to actually customize your plan. So you want to make sure that you're customizing these strategies to your situation, and that's why you hire someone like me to work with. So why don't we talk about the third point of how the right insurance will ensure the success of your financial plan. So when we're talking about insurance, I'll just really just line up what they are and the ones that you need. I'll start with the one of utmost importance, of highest importance, going down to the one that's not as urgent of a need. Water break. Okay, so I'm back. So let's talk about insurance. Number one, health insurance. You hear it all the time. It's incredibly important. If you're with an employer that provides it, you are very fortunate. You're very blessed, especially if you have a good plan. So if you do not have it offered through your employer, either one, you're self-employed, unemployed, or you are retired. So I'll talk about those scenarios now. So health insurance, when you are self-employed, it's so important with the revision and kind of the reversal of the Affordable Care Act. Insurance is no longer required. There's no longer a tax that is imposed if you don't have health insurance. I'm not a big fan of forcing people to get insurance. However, I really do believe that everybody should have health insurance. Think of the magnitude of the loss that you could experience because you didn't have health insurance and you have the income and the assets to pay for it. They will draw on all of your assets. You will go completely bankrupt. Your medical bills do not die when you die. And so if you die because of something and you have all these medical bills, your heirs or your executor will have to pay for them. I cannot stress enough the importance of health insurance. It is so important to have at least the bare minimum high deductible plan. If you're healthy, if you never see the doctor, that's fine. Pay for an insurance that costs $100 a month. It's very small, and then have the highest deductible possible, $5,000, $6,000. I don't really care what type of insurance you have. I just want you to have something. So that is incredibly important. But let's say that you are retired, and before you retire, let's say you retire before you are 65. And 65 is the age that I'm referencing, is because that's when you qualify for Medicare. So let's say you retire at 60, okay? You no longer have your benefits through your employer, right? But you still need insurance. So some employers provide gap coverage. Like I have some clients who work for Johnson & Johnson. And so they get some gap coverage until they qualify for Medicare, which is a huge benefit. So that's one. Well, child upset in the background. Don't mind that. So what I said is that Medicare. So what do you do between when you retire and when you're on Medicare? So you've got to go on the market and you've got to go purchase insurance. Now, depending upon how high your income is, you could qualify for a subsidized plan depending upon the state that you live in. So keep that in mind. But because of your age at that moment in time, it could be more expensive. And I've actually helped clients make a decision that they don't want to retire until they're 65 solely because of the medical costs. It's very significant, the cost of medical insurance after the age of 50 or 60, even more. You know, the older you get, the more expensive it is. So it's very important to consider that as a part of your plan. Your medical expenses, I've seen it where your medical expenses before the age of 65, but after you retire are about double if you don't have the employer provided subsidy or gap plan. So keep that in mind when you're planning for retirement. But health insurance, health insurance, health insurance. I can't say it enough. So then we've got, second most important would probably be your home and auto insurance. The reason I say it's so important is because the frequency of those accidents and issues is very high. So the higher the frequency, the more important the insurance. So that's why health insurance is so important, because one, it's very unexpected. Anything can happen. You could get sick. You could be in an accident. You need to make sure you're covered for those things. However, I would say next would be your home and auto, because those are mandated by state law. So you've got to make sure to have those things. And again, the quality is not as important as just having it. But when you're getting your homeowner's insurance, making sure that you're covering the actual value of your home. If you have less than 80% of your home covered, then you file a claim, your house burns down, you'll actually get a prorated benefit back for your house burning down. So make sure that you have enough coverage and that the whole dwelling is covered. Renter's insurance protects your contents. So even if you're not living in your home and you're renting, you get renter's insurance to protect the items inside of your home. Otherwise, you're out of luck and you have no money to replace the things that were stolen or damaged. So I'm a huge fan of renter's insurance. It's much cheaper than homeowner's insurance because you're not actually protecting any type of structure. Auto insurance, you could get collision. It just covers the basics. Now, here's what I do recommend doing is doing an insurance audit. I personally really like working with an insurance broker because they can shop out your insurance. They tend to do a better job at explaining your coverage, and they can modify your coverage very easily, and they don't have any skin in the game if you change your coverage to a different company. But if you're working with just a specific agent with a specific company, they have to recommend only their company's insurance. I'm just not as big of a fan of that. So that covers home, auto, and health. next is disability insurance is actually the next most important. I would say it's more important than life insurance. But before I move on, do I have any questions? Anyone? Bueller? Water break. Sometimes I feel like I talk a little fast. Oh, thank you, Linda. Good point. Umbrella. So umbrella insurance for homeowners. This is very important. It's very affordable. And so what does that do? It covers you for if you are sued. It protects you against a lawsuit. It's basically liability insurance if you're a business for your home. It's liability insurance for your home. So let's say someone's walking on your sidewalk. We're in Minnesota, but so this is specific to Minnesota. Let's say there's ice on your sidewalk. Someone slips and falls. They break their back. They could sue you for negligence, and they would most likely win. So very important to have that umbrellas insurance, because that would cover you for insurance for the lawsuit, and the coverage usually goes up to $1 million. Another thing about umbrellas insurance is that it can cover multiple properties. So if you own multiple properties and have an umbrella insurance to cover all of those properties, incredibly important. Thank you for bringing that up, Linda. Sarah says, I'm concerned about buying insurance and not using it. What happens if I don't use it? Okay, so health insurance you're going to use. Home and auto you're going to use it, and it's state mandated. So let's talk about disability insurance, because that's the one. Disability and long-term care insurance are the two types of insurance that I hear that question a lot. So let's talk about what they are first. So we've got disability insurance. So disability insurance is what protects your income if you become sick or hurt and you are no longer able to earn income. So that would mean that, let's say I'm making $100,000. I use 100 because it's easy math. I'm making $100,000 and I do not have any disability insurance and coverage in place because I'm self-employed and I didn't get anything for myself. And so let's say I have a diabetic coma, type 1 diabetic. God, that will not happen in Jesus' name, but hypothetically speaking. So let's say, I have a coma, and so I'm not able to work. What happens to all my bills? It's really a bad deal. And then let's say I get out of the coma, let's say it lasted a week. It's very minor coma in regards to that. But let's say now it takes me weeks to recover, months to recover. Let's say I get a concussion. I'm not able to do portfolio management. I mean, these are very important things. I have got my lovely assistant, Linda, but she's not going to be able to do all the things that I do. And so I'm not going to be able to take the same amount of income from my business. And then I could lose my house. I could maybe not pay for Zuri's school. I mean, there's so many things that could happen. And so then to Sarah's question is, well, what if I buy it and I don't use it? So that's disability insurance is a big question. So if the earlier you get it, the cheaper it is. So if you're young and healthy, then that's a really good time to get it because it's usually under $100 a month. I mean, it costs very little, much less expensive than health insurance. And with that said, I always tell my clients who are young, get disability insurance, protect your income, because you don't, especially if you're single, you're not married, you don't have anyone to rely on. So if you don't have anyone to rely on and you stop earning income and you still have bills to pay, how are those bills going to get paid? The risk of not owning that disability insurance is much higher than the risk of you're not using it. And another thing to consider is that 2 out of 3 workers experience this disability at least once throughout their career. And it could be short-term or long-term, but the risk of disability is actually higher than you would really think. And it covers sickness and injury. People think about injury when they think about being disabled, but sickness is actually a lot more common of a use for disability. It covers cancer treatment, chemo, anything where you're not able to work. And even if you receive a partial disability and you are able to work part-time, you can still qualify for a prorated benefit if you get disability insurance outside of your employer. Another reason to purchase disability insurance is to protect your bonus income if you're employed and you have a lot of bonus income. Then the other insurance that people are afraid of not using is long-term care insurance. So long-term care insurance is a type of policy that protects against a long-term health event, and those usually take place after you're retired because of old age and complications, medical complications of some sort. So when someone goes into a nursing home or assisted living, or they require in-home care, that would trigger a long-term care event, which would then allow you to be compensated long-term care insurance. So what if you're healthy your whole life, you don't use it, then what? Okay, so this is a nuanced one, right? Because if you're single and you don't care if anyone gets your assets, then so what, right? I mean, in my opinion, it's not as important. However, if you have a sizable estate and you don't want to bankrupt your estate, if you have someone else who's relying on your assets, such as a retirement plan, if you have children that you would like to be able to give your assets to after you pass away, long-term care is basically insuring your portfolio. And so if we think about the cost, the average portfolio and the average cost of long-term care insurance, it varies. However, you could lose all of your assets because of a long-term care event. If you're in a nursing home 24/7, you could lose all of it. So that's why when people say, what if I don't use it? The risk of not using it is so much lower than the risk of needing it and bankrupting yourself. And you would be surprised at how many people are not properly insured, and they should have been. So I don't want to be a doomsdayer. That's why I ended with the insurance, did start with it. But really, it's a foundation to your plan, and I think it's incredibly important. And so I'm a huge proponent of incorporating insurance planning into your plan. And that's why I mentioned that. And then there's also life insurance. Now, the thing about life insurance is that you're guaranteed to die at some point in your lifetime. So you know you will use it. There are different kinds of life insurance. And so that's why, again, you meet with a life insurance or an insurance agent to determine your need. But you could also work with a financial planner like myself because I'm licensed in insurance. So that covers, so let's just recap here. We talked about the budget, both for today and the future, and why that's important. We talked about automating your financial habits, so automating your saving strategies. Debt payoff too, automating that is important. Again, come up with a strategy, snowball your debt, work with a financial advisor to figure out how to do that and come up with a customized plan. And then automating your retirement savings, whether you're self-employed or not, you can do it either way. And 3, how ensuring the success of your financial plan. People aren't too big of a fan of insurance because they don't like to think about bad things happening to them. And it's hard for us to envision ourselves outside of where we are. But think about all the effort, all the hard work that you have put into building your portfolio or building your savings or purchasing your home, building your career. You don't want to lose that because you don't like insurance. So I really am a big proponent of it where it fits in. And it's usually a different plan for everybody. So it's not a one size fits all. And so making sure that you're on plan by making those right action steps towards your plan and then protecting them. So I think that covers everything. Thank you everybody for joining. I'm completely open to questions. I'm 44 minutes. I said 45 minimum, so I'm right on schedule there. But did anybody have any other questions before we skedaddle? Talked about the budgeting. Please let me know if you want the budgeting spreadsheet. And I'm happy to email it to you. Just make a comment, put your email in here. All right, I hope I got you thinking. Now, clients, if I have any clients on here, any of my lovely clients, would you mind sharing how you have built a foundation for your Darius? I got you. I'll email you the budgeting spreadsheet. So do I have any clients who are on here that would like to share just how they've maybe incorporated some of these habits into their financial plan, whether it's automating or the insurance or anything? I would love to hear, and that way you can share with others just how creating a foundation to your plan has been helpful to you. I would love to hear any ideas or thoughts. It could be working with me, or it could be working on your own, whatever it is. But I would love to hear, what type of habits have you incorporated, and how has that been helpful in giving you peace of mind and establishing the foundation to your plan? I would love to hear. I'm sure everybody else would too. Sarah says, thank you, Whitney. Great information. You are welcome, Sarah. I hope this was helpful to people. You know, it's like, this is information that I think about every day, but not necessarily people who aren't financial planners. So I like to share it and try to break it down as easily as I can to make it so that it's not so overwhelming. Does anybody have anything else to share? Because otherwise I might just call it quits. Declare war on debt. Linda. Yes. I have debt payoff plan for every single one of my debts. Make sure you do that. Oh, if anybody has any debt, I'm also happy to send you a debt snowball calculator. So I'll talk a little bit about that. I didn't talk about that, and this is automating since we have some extra time. So let's say you've got 3 credit cards and you got a car loan, okay? And your mortgage. Mortgage is last priority with accelerated debt payment because it's the lowest interest rate usually. So let's say you've got 3 credit cards and a car loan, and you got to look at the interest rate for each of those credit cards to determine which one you want to pay off quickly. So let's say you got one for 20%, one that's 25, one that's 14%, okay? And you've got about the same balance on each. So let's say you've got $500 a month that you can dedicate towards credit card payments, okay? Put all your extra money towards the highest interest debt first, and then put the minimum payments towards the lower interest ones. It may seem counterintuitive, you want to pay it all off at once, but by doing this, you're cutting your interest expense on the one that's costing you the most interest, and then you get that paid off more quickly by putting all your extra money on it, and then you've got 2 credit cards left in the car loan. Keep the car loan on the side, like again, it's the lower interest debt of the ones that I just mentioned. Now you got 2 credit cards left. Now that you have this extra, let's say $400 a month, because you directed it from that first credit card to the other 2, you put all your extra money towards the next highest interest debt. And believe me, if you want the debt snowball calculator, I'm happy to share it with you, but you will quickly pay off debt much more quickly than you would if you were just paying $150 or $170 on each of the credit cards. And it's just simple math. You just don't think about it that way. And it's a really good way to take care of your debt. Debt can ruin you if you don't have it paid off, especially if you find yourself in a poor financial situation. All right, anybody else before I head out? I know Linda's my assistant and my mother, so she's done a good job at paying off debt. If you don't mind me sharing, you're mortgage free. You didn't refinance your house too many times so that you would have to be in debt in your mortgage. So you're mortgage free, you don't have any credit cards, and you've done it because you don't have the credit card debt, you can accelerate your savings. So it really does help you a lot. The sooner you can pay off the debt, the freer you are, I'm telling you. I'm going to send this. Okay, guys, I think we're all done. Unless anybody has anything else to share. Like I said, there's a little bit of a delay with the live and then the comments. So I'm sorry if I don't think I missed anything. I got all the questions. So Linda says, thanks, Whitney. Thank you for joining me today. And I wish you all well. I just pray that you have a beautiful rest of your day. I pray you have a wonderful weekend that's coming up. I wish and pray for peace for all of you. And I just thank you for joining me and spending the time with me today. I thank you to my clients for joining and supporting me. I love supporting you, so I appreciate that support back. And I think we are good to go. So Toodles, I'm going to put my email in here for work in case anybody wants to shoot me an email with any questions. Whitney@strategicvisionaries.com. You're welcome, Pam. Thank you for joining me. Okay, I think we're all done, guys. Again, thank you again, and I hope you all have a beautiful